Welcome to The Explainer. You know, every single trader, from a beginner to a pro, wrestles with one huge question. It's not just what to buy, but when. When do you get in and when do you get out? Well, today we're opening up the toolbox designed to answer exactly that, technical analysis, and we're using some great insights from Technical Analysis for Dummies. You've heard that saying a million times, right? Timing is everything. Well, in the financial markets, it's not just a saying, it's literally everything. Get it right, you feel like a genius. But get it wrong, and the consequences can be pretty severe. And that's the core problem we're digging into today.
And this cartoon, oh man, it just nails the trader's dilemma perfectly. See, it's not just about picking a winner. The real million-dollar question is when to jump on board, and maybe even more important, when it's time to jump off. Getting that timing wrong isn't just a little oopsie, a minor setback. The math of a bad trade, it works against you in a way that can be, honestly, kind of staggering. Let's actually look at the numbers.
Okay, this is where the brutal math of trading really hits you. Take a look at that 50% loss. If your account drops by half, you don't just need a 50% gain to get back to even. No, you need to double your money, a 100% gain, just to get back to where you started. Think about that climb. It's a huge psychological hurdle. And it's the single best reason why your number one job as a trader is managing your downside.
So, with that daunting math staring you right in the face, how do traders even begin to try and solve this timing puzzle? Well, they turn to a very specific set of tools. So let's go ahead and open up that toolbox.
So at its heart, what really is technical analysis? It's basically the study of price behavior itself. Now, this isn't a crystal ball. It's not about magically predicting the future. Think of it more like a framework for using a price's history to make smarter decisions, all while keeping a laser focus on one thing, managing your risk. Here's a really simple way to break it down. You have fundamental analysis, which looks at a company's health, its earnings, its debt, its management, to decide what to buy. Then you have technical analysis. It looks at the price chart to help you decide when to buy and sell. They're just two different toolkits for two different jobs, and yeah, you can absolutely use them together.
All right, so the very first tool we're pulling out of the box, think of this one as your compass. Before you do anything else, you absolutely need to know which way the market is heading. And that brings us to the first principle: follow the trend.
I'm sure you've heard this 1,000 times. The trend is your friend. You know why it's such a cliche? Because it's true. Trying to fight the market's momentum is like trying to swim upstream against a powerful current. It's just so much easier and way more profitable to just ride the wave. So how do you actually spot a trend? It's surprisingly simple, really. An uptrend is just a series of higher highs and higher lows. Just picture yourself walking up a staircase. A downtrend, it's the exact opposite, lower highs and lower lows, like you're walking down that staircase. That's the basic visual. It's that simple.
And listen, this isn't some newfangled idea dreamed up last week. These core concepts were laid out more than 100 years ago by Charles Dow himself. Yeah, that Dow, as in the Dow Jones Industrial Average. He was one of the first people to really document how markets move in these predictable trends and how those trends tend to stay in motion until some major force stops them.
Okay, so if our compass tells us the direction of the trend, our next tool helps us understand the engine that's actually driving it. Let's call this one our crowd meter. It's a way for us to read the collective psychology of the market.
Now, for this next part, you might have to forget what you learned in your Econ 101 class. See, in most places, when the price of something goes up, demand goes down. But in the stock market, it's often more like an eBay auction. A rising price signals that something is desirable, which then attracts more buyers, which, you guessed it, pushes the price even higher. Visible demand creates more demand. It's a total bandwagon effect.
But that bandwagon can't just roll on forever, right? Eventually, you hit a point that traders call overbought. And all that really means is that the pool of new buyers is starting to dry up. Pretty much everyone who wanted to buy already has. And with fewer new buyers coming in to push the price up, that upward momentum can stall out pretty fast, which makes a price drop a lot more likely.
And the same exact logic works in reverse during a big sell-off. When a stock becomes oversold, it means the fear has basically peaked. Nearly everyone who is going to panic and sell has already hit the exit. And once all that selling pressure is gone, well, the path of least resistance is often back up. These are the emotional extremes that drive the market crowd.
So, we have a compass for direction, and we have a meter to gauge the crowd's emotions. But none of that really matters without the most important part of the whole toolkit, the user manual. And this is all about your mindset.
Okay, this is the single most important thing to get. None of this is a magic formula. No tool works all the time. The goal of a really successful trader isn't to be right on every single trade. That's just impossible. The real goal is to use these tools to stack the probabilities in your favor and, most importantly, to have a plan for what to do when you are inevitably wrong.
And this slide right here brilliantly illustrates the real secrets of top traders. It's not about some hidden magic indicator. It's all about discipline. It's about befriending the trend, taking full responsibility for your losses, focusing on actually making money instead of just trying to be right, and of course, knowing when to cut a losing trade.
So in the end, technical analysis gives you an incredibly powerful map of the market landscape. But here's the thing. A map doesn't tell you where to go. Real success isn't found in the charts themselves, but in the discipline and the strategy of the person who's reading them. The tools are right here. The answers? Well, they're up to you.